thinking of scaling? At what point should you perhaps start considering establishing subsidiaries in different jurisdictions? At what point does that emerge? So we'll pretty much just be covering this. We'll be looking at how companies evolve, right, from local businesses into international groups. We're looking at when founders should consider restructuring. We'll also be covering how investors evaluate global corporate structures. And this ties directly into the legal due diligence that my colleague had spoke extensively about. And we would be also looking at common mistakes that create friction during fundraising and when companies, founders, business owners decide to expand their operations. And we will finally be considering practical frameworks for entering new markets. So generally, from my experience, what I have seen in practice is a lot of times founders, business owners do not think about structure in the real sense that they should be thinking about it, right? In fact, a lot of times we find out that business owners, founders think structuring a company or looking into restructuring the framework of a company is it's more like peculiar to multinationals. It's something the big companies do, as opposed to evolving entities, evolving companies. But it goes beyond that, right? From the point at which you have an idea, right? From the point at which you begin to develop an idea, you incorporate a structure in whatever jurisdiction, you should be considering the structure. You should be considering expansion. You should be considering the possibility of expanding the frontiers of your business. And in this sense, right, it doesn't necessarily mean looking at restructuring at that moment, but looking at it as a futuristic event, something that could happen along the lines. And so at the point where you incorporate a company, at that point you should already be thinking, okay, where should my IP sit, right? And the possibility of an exit, because most often than not you find out that founders don't really think about exit, right? They don't really think about, oh, what happens in the future. They are more fixated on, say, the commercials, like hiring, getting key hires on board, getting their product out into the market and getting customers to walk around the products that they are putting out in the market, but they don't consider the corporate structure holistically, right? And why does this matter? This matters firstly for fundraising, because I mean, after you have created your product, you have incorporated your initial entity, you have gotten on board your key hires. Eventually, as you continue to enter into the market, as you continue to scale, as you continue to put your product out there, put your service out there, at some point you would begin to consider fundraising, right? And as you consider fundraising, investors would be very particular about the structure of your organization, because investors don't just care about the money that they are investing into your company, right? The bigger picture for them is what they are getting out of it, right? The profit, what the dividends they will get at the end of the day, right? And your structure in a very, very large way influences that output, because I mean, before the fundraising process goes full bore, right, you have the due diligence process. And once the due diligence process kickstarts, investors, lawyer, legal representative that they have on board would flag whatever red flags that they identify in your corporate structure. So your corporate structure is really very important from the get-go. Also regarding expansion, right? the structure that you have, that you create, influences your ability to enter into new markets, your market entry, right? Because if your structure is poorly put together, the possibility for you to expand, right, would would be very uh tardy. It wouldn't be neat. It wouldn't be easy. And in the long run, you find out that you'd have to expend resources, right, trying to fix the issues that could have easily been fixed at the point of incorporation of your entity. Also, in terms of strategic partnerships, mergers, acquisitions, and founder exits, just like I had mentioned earlier, right? Your corporate structure would be analyzed, right? A whole lot of things, like what is behind, when you talk about a company, what sits behind that name, right? How is the framework, how is the structure like? All of this would be analyzed when you're trying to enter into strategic partnerships with say technical partners, business partners, or say you're trying to merge with another company, or your company is about to be acquired by another company, or you're trying to exit the company as a founder, right? Either maybe the company is going public, whether it's an acquisition, whether it's a management buyout, regardless of the nature of the exit, the corporate structure would be analyzed. And so that's why it's very important that from the point of ideation, right, you start thinking about your corporate structure, right? Not just theoretical, but in terms of like practical terms. Okay, so the next slide here is startup evolution. As I had earlier pointed out, right? You have a company, the company is domiciled in a particular jurisdiction, right? And you have your operations in that jurisdiction. You have say, for instance, maybe the founder is also domiciled in that jurisdiction. You have your key hires in that jurisdiction. At what stage do you now begin to consider a group structure, right? So we have obviously have different structures. We have the holding company, we have the operational subsidiary, and we also have branch or representative of offices, right? So at what stage should you now decide to restructure your entity into a holding company with an operational subsidiary, or a holding company with branch or representative offices in other jurisdictions where the laws of those jurisdictions allow? I'll say the point where you should start considering establishing uh, an entity, or establishing a group structure rather, would be at the point where you have entering into talks with investors, right? Where you started um reaching out to investors to invest into your company, to invest into your business, or where you have, or where investors have started reaching out to you because they have seen the viability of the product that you are putting out. So where investors have started reaching out to you, or where you have started reaching out to investors, you started having very serious discussions or conversations with investors, then you should start considering establishing a group structure. Also, when you have started getting, say, customer feedback from other jurisdictions, and tested you've done your testing, right, in terms of the customers who are reaching out, to see that there's an actual demand, an actual market for you in those jurisdictions. And then you should start considering establishing a group structure. So you shouldn't from the get-go just, create multiple entities because it sounds nice to do, or it sounds like it's a common thing to do, is what people are doing. There should be reason, there should be a commercial basis, right? So this is before you decide to restructure your entity into a group, right? Have a holding company, have a parent company, right? It's firstly a business decision before it is a legal decision, right? So in practical terms, this means firstly think about it, the viability of restructuring your organization, right, before reaching out to a lawyer to help you, do the legal work, do the filings, and correspondence with with regulators, as the case may be. So I touched on this briefly in terms of like the common global structures that we have. We have the holding company, we have the operating subsidiary. This structure is more or less having a parent entity. Most often than not, the parent entity is the vehicle that investments are done in, right? The operational subsidy, the operating subsidiary rather, is the vehicle that does the day-to-day activities, right? We call it in quote the dirty work in that sense, right? So the holding company bears most often than not what you find, and what obviously should be the ideal thing is the holding company holds both the IP. The holding company is the vehicle that investors invest into, while the operational company does day-to-day daily work, right? So this helps to minimize the risk that are attached to the holding company. It is also through the holding company that investors are able to see and understand the framework of the business in terms of like having a branch or representative office. And this, most often than not, you see this play out where a company is trying to test the market in another jurisdiction. And this, you only see this where the regulations in that jurisdictions allow. So they establish a branch or a representative office, right, in that jurisdiction, but the representative office functions under the name of the holding company. So every hiring, every risk, every liability resides in the whole co, while the branch or the representative office pretty much just represents the parent entity in that jurisdiction. Now, what is the best structure, right? In terms of, so when you're thinking about structuring your entity, when should you, what should influence your decision to establish a hold co and a subsidiary structure, or a hold co and a branch office, or simply just have your company is a single entity operational uh, in a country? The first factor that I highlighted here is where your customers are located, right? Now, if you have customers in different jurisdictions, right? If you have a demand, not just people who are enthusiastic about your product, but like people who are ready to uh, spend their money, put their card into your process and spend their money on the product, on the service that you are offering. That's when we say that's when the factor regarding where the customers are located becomes essential. Also where the founders are located. Now, most often than not, you see the founders sit in as a director in the board, part of the board. You also see that the founders are shareholders, right? They hold equity in the company. So this is also a factor that influences where the where how the entity should be structured. The next we have here is where your investors are located. Now, where the investors are located plays a crucial role in determining the structure that you should adopt, the framework, the corporate framework that you should adopt. Reason being that a lot of times, right, investors want to invest in the hold co, right? So they more okay. The reason usually is that the parent entity hold co structure helps with visibility into what the operational companies do, and also it helps to minimize risk, right? Also, most often than not, investors have particular jurisdictions that they favor, majorly because those jurisdictions may be tax neutral or tax friendly zones, right? And also because those jurisdictions, they are familiar with the laws, they're familiar with their courts, they're familiar with the paperwork and the commercials around that. And you find out that a lot of times, like if your investors are institutional investors, like asset managers, pension funds, private equity funds, venture capital funds, they tend to favor Delaware as their choice jurisdiction. So you shouldn't just outrightly opt for Delaware, right? Because it is the common practice or because it sounds nice or fancy to do, but it has to be a commercial decision, like I had said earlier. So where your investors are located. Also, in terms of like regulatory requirements, right? If you are entering into a market and um that particular market, right, the country has local laws, local licensing laws that you need to have before you can become fully operational in that region, in that jurisdiction. It then means that there is a need for you to have an operational company in that jurisdiction. So at this point, you are now thinking of having a hold co and an operational entity structure. Also, your exit strategy, right? If you want to exit your business, right? So, exit is pretty much how you are able to uh, convert your equity, the securities that you hold in the company, and exit and leave the business, right? So, if you want to exit the company, how should the structure look like, right? What will be the easiest and the best way for you to exit without having any issues, without having any encountering any disputes at the point of exit. So this is pretty much what you consider to determine whether you should have just a single entity or if you should adopt a parent entity and a hold co structure. Now, in terms of like cross-border expansion, we're talking about cross-border expansion, right? You're looking at expanding beyond the frontiers of one jurisdiction. So perhaps the perhaps the company was operational, say in the UK, right? And you have tested, you have validated your product in the UK, you have a demand, you have a market for it. And then over the course of the years, over the course of time, you find out that there is now a growing demand, a growing market for your product or for your services. At what point can you say, okay, it is now time for me to, or for the company to expand, right, beyond the frontiers of the UK and enter into a new jurisdiction, a new market. Before you take on those steps, right, you firstly need to test the market. And I think I earlier just briefly touched on it, right? You need to know if there's an actual demand, for that service. Like you need to know if you'll be able to generate revenue from that jurisdiction, and if it is not such that you can operate there without necessarily uh establishing an entity there. So that's pretty much the market testing phase. And you could possibly put out questionnaires, you could carry out a survey in that particular market just to ensure and ascertain that there's actually a market for you there in that entity. Also, in terms of revenue validation, right? In terms of revenue validation, this pretty much has to do with the ability of the people, the customers, right, in that jurisdiction to actually pay for your service, to actually pay for this product that you are putting out there. So this is the point at which we have revenue validation. Then we have formal market expansion. And formal market expansion happens when you have tested the market, you have validated the revenue, that okay, there is actually a demand, right, for your service, for your product in that jurisdiction, and there is a need for a local presence for your entity in that jurisdiction. Then you can then proceed to asking your lawyer to get paperwork, reach out to regulators, and formally establish your entity in other jurisdictions. So more or less, having your entities uh, operate cross-border. So those are the three phases that I would recommend that before you decide to expand into other regions, other territories, you consider the market testing phase, your revenue validation phase, and your formal expansion phase after you have validated phase one and phase two. uh, Intellectual property and international hiring. Now, this is a very salient point when you are considering expanding into other jurisdictions, cross-border structuring, and having a hold co and an operational entity structure. And the reason is this: in terms of in earlier we I had touched on the reasons, some of the factors you should consider when you are considering expanding into other jurisdictions. At the point when investors, right, want to invest into your company, when they are carrying out their due diligence, one of the things that they will check, that they will look out for, is your intellectual property, right? Because the intellectual property is an asset to the company. It's, to a very large extent, also determines the valuation that is attached to that company. To minimize the risk, right, and not and ensure that IP rights are not tiered and owned by different parties, different entities. For instance, you are developing a product, you have um, the developer that wrote has created the code, you have your trademarks, you have your designs, you have your digital assets, and all of these are created by different persons, right? But the rights to all of these IP works are not assigned to the company. It would pose an issue at the point where the investor wants to invest into the entity. It also creates risk, right? And the holdco operational entity structure ensures that there are minimal risks that are attached to the parent entity holding all the IP rights. So where the parent entity holds the IP rights and the operational entity does the day-to-day activities, it then means that if there are any liabilities, if there are any claims, if there is any legal action or anything of sort, those liabilities, those risks would be attached to the operational company and not the the hold code that holds all the IP rights, all the IP assets. And so it's very important that at the point of structuring your entity, right, from the point of ideation up until the time when you incorporate your single entity, and if you deem it fit, you consider it necessary to expand beyond the frontiers of um, the maiden jurisdiction, you ensure that all IP rights are assigned to the company. And in a hold co parent entity subsidiary structure, you could find out that there are incidences where you have the operational company utilizing, some of the IP rights or the IP works that have been assigned to the holdco. In such a situation, you ensure that there's a sort of licensing agreement, right, that shows how the operational company is utilizing these IP rights that have been assigned to the holdco. If you also have incidences where say codes or any IP work generally has been done by key hires or consultants or personnel that you have engaged at the operational level, you need to ensure that they are all assigned to the hold co, just to ensure that you are minimizing risk and keeping it to the barest minimum. We also have the factor you can consider in terms of like hiring, right? When you're considering expanding beyond the frontiers of a single jurisdiction, there's the one consideration that you would make is whether it is necessary, right? Whether it's necessary for you to hire um hire personnel from those other jurisdictions. I think this is also a business decision that you would need to make. But key points that you need to note is you don't necessarily need to hire on a full time from these other jurisdictions. Firstly, you can have personnel that are engaged via service level agreement. You could have independent contractors, right? So these persons are not formally engaged to the company. They work on their own terms, but the terms are agreed between these personnel and the company. You also have employer of record arrangements. The employer of record arrangement is such that you have entities in in several jurisdictions that oversee hiring process, right? So you pretty much just contact them, you tell them your needs, and they supply the workforce. But the workforce works for those entities, not the company. And so the company pretty much just pays a service fee to the employer of records that handle these arrangements. Then you have local subsidiaries, and this arises in terms of hiring, international hiring. This arises when you have established that there is a need for a local presence in that jurisdiction, and then you can then have local hires that are hired by that local subsidiary of the parent entity, and they'll be bound by terms that the company issues to them. So um you need to as I said earlier, this is a business decision that you need to make, right? So if you have, say, a demand in another jurisdiction, but you have analyzed, you have done all your testing, your market testing, your revenue validation, and you have seen that there is no need, or the results that you have gotten from the test phase that you have carried out shows that there is no substantial, you cannot really validate the need to expand into other entities, but you have a demand there, you have a growing demand there, and perhaps um you need personnel from those jurisdictions to carry out one or two activities for the company. You could consider having independent contractors, or reaching out to entities that carry out employer of record arrangements, and have them provide personnel for the company, as opposed to moving on to create local subsidiaries in those entities, in those jurisdictions rather. And when does restructuring becomes necessary? Restructuring becomes necessary when you have investors, when you're in talk with new investors, right? And in short, from the point where you have initiated communication with investors, or you have had an investor reach out to you, they've, even before they share a term sheet with you, you should already start considering that there is a possibility that you would need to restructure the organization. And when you're thinking restructuring, don't think that it is something fatal. Restructuring is simply a sign of growth. It is a sign that the company is growing, the company is expanding its frontier, because there is a growing demand for its service, its product offering that it has pushed out into the market. So also, when does restructuring become necessary? When there is a need for international expansion. When say you have a demand in a jurisdiction, and for you to become operational in that jurisdiction, you require local licensing. So then you know that, okay, the company needs to restructure, the company needs to expand, and then you can start putting in the paperwork to ensure that is done. Also, in terms of regulatory requirements, now this ties back to the previous point that I just spoke about, right? Regulatory requirements, where the local laws in that jurisdiction that the company is about to be operational requires licensing, requires compliance requirements, that requires you to establish an entity in that jurisdiction. Then you know that you need to start considering restructuring. Also, in terms of mergers and acquisition activity, when you are trying to merge with an entity, when there is acquisition talks on the way, you know that there's a possibility, there would be a growing need for the company to restructure its structure to adequately accommodate the activity. So in terms of like tax optimization initiatives and founder changes, for instance, where a founder who perhaps is an employee of the company and also a shareholder uh, changes his place of domicile, right? There may be a need for the company to restructure and have say a hold co resident in that jurisdiction where the founder is, and the operational entity in the jurisdiction where he has left, where the company does its day-to-day activities. So in terms of common mistakes that we see on a day-to-day, when people, when founders, business owners are considering restructuring their entity, or when there has been a need for them to expand beyond the frontiers of the market that the company was initially operational in. One of the common mistakes that we find is there's no IP assignment. We find that either the IP rights are tiered, so as opposed to the IP rights being owned by the company, the IP rights is owned by the founder, is owned by developer, is owned by an employee who created something, or built something that has aided the company's products. So we find that happening, and then it now leads to, say you're in a fundraising mode, or you are in talks with an investor. It has the capacity to slow down things, and it could also be lead to more costs that you would incur at that point. And this could have easily have been solved at the point where the entity was came into existence. We also have mistakes that we see where founders own the assets personally in order to minimize risk, in order to ensure that interests are well protected. It is always advisable, and this is something that investors would always look for, to see that um, all assets are assigned to the company. So whatever assets, whatever IP has been created by the founder or whoever, whatever personnel that has built, has done anything for the company, should be the rights to those assets should be assigned to the company and should not be held personally. We also have issues around poor governance. Now, governance pretty much is how a company is run, how a company is administered. But you find out that a lot of times when a company comes into fruition, a lot of times either one person or two persons have an idea and they decide to you know kick off a company. But then, and we see this a lot of times when the persons, the business owners or the founders are friends, they're on friendly terms, and so it almost seems like there is no need for you to have paperwork involved. Have a founders agreement, have a shareholders agreement, or you find out that a founder has say promised to issue equity to his employees or to family, or anyone like that, but this is not well covered, right? There's no, you say you're going to create an ESOP pool, right? But there's no documentation regarding that, and all of that. And so at the point where, say, there is an exit and sign-offs are needed, you now have a friction because you're trying to determine who needs to sign off, who do I need to reach, who do I need to engage in that sense. And so it is very important that at the point where you are structuring your organization, you're structuring your entity, governance frameworks are put into place. Who does what, who says what, who can give a sign off on what, in terms of like key hires, who has the final say. All of this should be properly documented. Should also have resolutions in place regarding that. If you are going to be issuing securities, you should have your investment agreements that speak to these securities, right? So that at the point where you are approached by an investor, you are able to say, okay, this belongs to this belongs to this person, this is the governance framework, this is how the company is run, and you have your paperwork to back it up. It shows that the entity has a good structure, has a good governance framework. Also, in terms of cap tables, unclear cap tables, at the point where you are structuring your entity, you need to ensure that whatever equity has been issued, whatever has been given out to anyone really, whether ownership by the founders, ownership by employees, if you have created an ESOP pool, for instance, if you have issued securities, safes, convertible notes, whatever really is properly documented, so that at the point where an investor wants to invest into your entity, right, they're able to see who owns what in that entity. Then in terms of expansion without
Hi,
regulatory analysis.
Inikpi, so sorry to cut you off. This is just a 5 minutes reminder, please.
Okay. Okay, great. I'm rounding up now. So in terms of expansion without regulatory analysis, before you decide to expand beyond the frontiers of your initial market, you need to first test the market, analyze the market, right? Know if you would require local licenses, know what the laws in that jurisdiction states, right? So reach out to local council that is resident in that jurisdiction, or even local council in the jurisdiction that you're currently operational. Let them help you take a survey into that jurisdiction, so they know what it is like, what the regulatory climate is like, before you decide to expand into that jurisdiction. Another is copying another company structure. Different companies operate differently. So, for instance, you see an entity has a parent hold co resident in Delaware, and instinctively you think, oh, I need to have a Delaware, I need to establish an entity in Delaware as my parent hold co. The rationale for you doing that is wrong, because the reason for the other entity having, the parent entity there could be because their investors are resident there. They have institutional investors that are resident in Delaware who would prefer to make their investments in Delaware, and that's why they have done that. So you need to ensure that you're not, there is a commercial rationale, there's a business reason why you have decided to go into a particular market, and not just because it is the common thing or everyone is doing that. So I have a lag on my slide, but yeah, so I think this is my final slide though. So conclusively, your corporate structure should support your business